going on, everyone? Lalit here. Today we got Rocket Mortgage's Q3 2020 earnings report release. We'll get straight into it. Leave that like. I'll see you on the other side. Starting us off, we got Rocket companies. You got beat by 12 cents on non-GAAP EPS, but GAAP EPS missed by 59 cents a share, but beat on revenue by 190 million. You got an announcement of $1 billion share repurchase authorization, but we'll get to that soon enough. The major headlines before we get into the financials is that you got closed origination volume up 122% year over year to a record $89 billion for Q3 2020, literally $1 billion a day. You got increased GAAP net income 506% year over year to $3 billion, and that same announcement of $1 billion share repurchase authorization. And one of the goals that Rocket has had even from Q2 2020, and they've stated it clearly, is that their plan is to capture 25% of market share by the year 2030. Since Q2 2020, there have been some developments, and they're here on screen, but I'd like to specifically highlight a few over here. And so, starting off, you got Mint by Intuit. Intuit are the same folks that have TurboTax under their belt. And so, this partnership, it's essentially an API integration into Mint's app, and it was said on the earnings call, but in as little as 8 minutes or less, one could be approved for a Rocket Mortgage loan through the Mint app. Then you got, and they don't say the name, but one of the largest financial services companies in the world, a new relationship with them, and it's similar to the one they have with Schwab, aka Charles Schwab, and it says it which allows us to originate mortgages for a new base of clients. So it'll be really interesting, and I'm looking forward to that news. And then you got Rocket Pro Insight, which essentially is giving visibility to real estate agents to get those real-time updates of the status of a loan. And where this benefits Rocket in this case is basically not having staff that's answering these type of questions because it's already in this automated per se solution. And on the flip side, you have customer satisfaction from a clientele perspective on the real estate agent and their client, and on the real estate agent side as well, which only deals with real estate agents wanting to deal with Rocket that much more. It saves on time as well as cost, and it's efficient as a system overall, integrating this technology into the day-to-day processes. Talking about their share repurchase authorization. So overall, over the next 2 years, and as it says, not to exceed $1 billion in repurchase, they're basically going to be purchasing their shares. And as they said on the earnings call, they were stating how if Rocket is undervalued, which is what they feel right now, they might as well buy more shares because they feel they're more valuable than what the stock market has pegged as its value today. They had a special dividend back in the day when Rocket was private, and so they said that they wouldn't do that again, but instead they would be repurchasing these shares, and so that's how shareholders would be benefited. Instead of getting a dividend, at least the company's rebuying their shares, and so this repurchase will only inflate the value is the expectation / hope that they gave off, especially in the earnings call today. Here we are with the Q3 financials. You have closed loan origination volume of almost $89 billion as we discussed, and year over year from a quarter comparison, you have 122% in terms of growth, and a net rate lock volume of 101%, so it's literally double, and then some. You have increased gain on sale margin by 37% year over year to a historically strong 4.52%. You have total revenue net and adjusted revenue up by 186% and 163% respectively. And noticing the total expenses though, it's up by 46%. And what they attributed it to was essentially higher variable compensation that's paid out in general to partner networks and otherwise. And further, they also talked about how basically they have 2,900 technology team members and they're spending more than $500 million annually for this, but not just for any reason. It's primarily to increase their monthly loan production capacity as well as enhance efficiency. So it's increased expense, but it's for the greater good in terms of their total revenue in general. There were a couple questions during the earnings call, and the answers to these questions actually give some insight into Rocket and its future, as well as the future in terms of leadership's eyes. And so I wanted to give this insight here. So one of the questions was, well, there's 92% in terms of this retention rate. And so what does this mean for the future in general? And this was really in comparison from 92% retention, and it was this retention rate versus recapture rate. And so if you keep 92% of business, and especially in these times where refinances are heavy just due to taking advantage of interest rates, why would one stay with Rocket? And so what Rocket's response was essentially was, you have 92% in terms of folks that are staying, but folks stay when interest rates rise naturally because they won't find a better deal. But now with this recapture rate, what's happening is even with interest rates going down, just the way Rocket targets and Rocket works with their customer, they basically have a lead in that angle as well. And that lead is 4.6 times the industry average. And so what they called it was essentially a hedge. And so in times like this, when people are going out for the refinances, it's actually not that folks aren't staying with Rocket, but they can also recapture them for the same business. And that was pretty impressive, not just in the short term, but just understanding that they basically are winning on both sides. Another question that came up was regarding their acquisition of a company out of Canada named Finmo by Lendesk. And basically the answer was, hey, we've been handling capital allocation for 35 years and have a great track record. Our goal is to have a great balance sheet and reinvest it into Rocket, whether we're spending on marketing for the brand or technology to build a platform or considering M&A activities. So the overall answer from leadership was basically saying, hey, we're doing whatever's best for the company and the shareholders in general overall and for the future of the company and the growth. And so overall, it was one of those answers where I understand where they're coming from. They didn't give too much detail, but I can understand that they're really looking at the long term versus the short term, especially coming back to the whole strategic objective of getting that 25% market share by 2030. Finally, to wrap us up, we got the current environment. And as it says, our net client retention rate was 92% and our client refinance recapture rate was 82% over the 12 months, which ended September 30th, 2020. Now, what's crazy about this metric is that they actually go above and beyond and outside of the mortgage industry to compare it to literally the Netflixes and all these other subscription-based type of services and say that, hey, we're better than all these other products, and specifically to this, our percentage in terms of our rate is that much higher and it's the best. And on the second bullet, they're talking about the Roni Rona, where they got approximately 84K clients, or 4.1% of their total servicing portfolio that were on a forbearance plan. And so comparing that to the industry average, it's far less than 5.8%. And so that's a big win for Rocket Mortgage. With that, thank you so much for coming to the end. You know how it is. Like, share, subscribe. See you soon enough.